I think a lot of people who haven't gone through the sale of a business probably don't understand is that our processes will take 8, 10, 12 months, 4 or 5 months of heavy due diligence. And it can be really taxing on management and business owners. If I were to ever sell a business, and I have done this, you would definitely want to bring an advisor on to just make sure the process is run professionally. They're negotiating on your behalf. They're kind of taking the emotion out of it for yourself, because it can be a very emotional process as well.
This is Net Learnings, the podcast that keeps finance and banking professionals ahead of the curve. In each episode, we focus on career growth and practical advice, while mixing in the occasional war story. Join us as we tap into the minds of leaders and experts at some of the world's most notable financial services firms and enterprises. Let's get started.
Hello and welcome to Net Learnings. I'm your host, Kyle Peterty, and I'm really excited about today's chat. Our guest is Yashar Farmanara. He's a director, corporate finance with MNP. MNP is one of Canada's leading professional services firms, providing client-focused accounting, consulting, tax, transaction advisory services, and they have over 7,500 staff spread across 117 offices around the country, including their Vancouver office, where Yashar is located. Yash, welcome to the podcast. Thanks for joining us.
Thanks, Kyle. Really happy to be here.
Just a reminder that the views and opinions expressed today by our guest are solely his own and do not reflect those of his firm. Now, with that out of the way, one of my pet peeves about finance and financial services in general is that we tend to really overcomplicate things. So let's just make this dead easy. Tell us, in your words, what is corporate finance, as though you were trying to explain it to like a 10-year-old.
Yeah, absolutely. I agree with you that I think sometimes we overcomplicate things. Corporate finance, I would speak to as more of a general concept. And so when you're dealing with a business, the corporate finance structure of a business typically deals with how you generate funds, how you generate money, cash flow, financing, and then how you deploy that financing and that cash flow in order to increase shareholder value. And so typically, a lot of people would consider, only the operations of the business. Obviously, the business is operating, and that's how they generate their cash flow. But there's additional ways you can generate financing, whether it be through equity or debt raising or other kind of functions. And that's really where MNP and our group steps in, is helping companies generate additional financing through non-operating factors, and then how to deploy that capital into projects or acquisitions or otherwise.
That makes total sense. Sort of a concept than a job, even though it's in your job title, right? Like I think your role would probably be best characterized as advisory work. Is that accurate?
Yeah, we're here to help bolster the corporate finance division of our clients.
So how is advisory work at a firm like yours different from or similar to investment banking? I mean, it sounds like it has some similar characteristics.
Yeah, it certainly does. An investment bank, again, is kind of an overarching term. Investment banking at, what people would consider a typical investment bank, a large kind of Goldman Sachs or Morgan Stanley, they would have various functions, whether it be sales and trading of securities on behalf of their clients. They'll have an M&A advisory arm on behalf of their clients. And then they'll also have kind of an investment banking group that works with a lot of public companies, helping underwrite IPOs and that sort of thing. And, the biggest difference between a pure advisory group like MNP Corporate Finance and an investment bank is we don't take on the risk of, we don't underwrite securities, so we don't take on the risk of the transaction of the securities. We're a purely advisory brokerage arm. And so we'll advise on M&A, we'll represent our clients, but we don't do any of the underwriting. We're really just a connecting group between buyers and sellers.
So if they needed to raise funds, you would bring in a financial institution as opposed to helping them with a bond issuance or something. Is that fair?
Yeah, I mean, we will broker deals, whether it's, equity or debt brokerage. So we can advise with banks, we can advise with individuals looking to raise minority stakes in their business. But if it's going to be a public typically if it's a public offering, then our clients will bring in kind of an external investment bank to do that. And sometimes we'll still kind of help advise them. If we're a trusted advisor, they'll want us to kind of be along in that process, but we won't do the underwriting.
Got it. Okay. So what sized companies are you and your team usually working with?
Yeah, that's another good question. And it really ranges. I mean, We do a lot of work within our MNP client base, and that client base kind of ranges from anywhere from $1 million of EBITDA, even $1 million of cash flow, up to kind of really an unlimited top end. I think if you talk to a lot of M&A advisors, just because a company is bigger doesn't mean it's more complex. Often the smaller deals can be more complex. And so
That's fair.
We're restricted really not on the top end. We've kind of got a minimum size where it economically makes sense for our clients to bring on an advisor. And yeah, we've done deals up to people in our group have done deals up to $30 billion. And so there's a fairly big range there.
Yeah, okay. That's fair. Probably wasn't a fair question, but a good answer. Thank you. So let's roll out a scenario then. Let's say I own a third generation manufacturing company here in Western Canada, 100 million in sales, 15 million in EBITDA. Give me your 30-second elevator pitch. Why MNP?
Yeah, I mean, the first thing I'd say is congratulations on having a third generation manufacturing business. I think if you look at
$15 million EBITDA too.
Well, yeah, especially with a $15 million EBITDA. I think if you look at the stats, with each generational transition, there's a higher and higher risk that it doesn't successfully transition to the next generation. And that's for a variety of factors, and usually it's kind of kids not really wanting to step in and take on that ownership and the stress of really owning a business. It's no easy task. And so
right.
The first thing I'd say is congratulations. I mean, why hire MNP? I think there's a couple reasons. The first and the biggest reason is that running a divestiture process, we call them divestitures if you're looking to sell. Running a divestiture process is really a full-time job. And as a business owner and oftentimes operator, your sole job is to run the business. And so a lot of people will try and run a divestiture process on the side of running a business. And the risk of doing that is neither will go well. And the worst thing that can happen during a process is your business results start to struggle.
Right.
And that's not what you want. And so when you hire a group like ours, we kind of take the end-to-end process. We maintain confidentiality throughout the process, and we bear the load of prepping the materials, finding the buyer groups, doing all the communications, and really only take our clients' time when it's absolutely necessary.
That makes sense. And it's funny how often we as humans tend to think we can just do things ourselves. Like an example, I've often thought, it'd be much cheaper if when I decide to sell our home that, I just do it without a realtor or without realtor representation. And if you stop to think about it, that's kind of foolish, really. I mean, you should probably just let the pros do their work. And frankly, residential real estate is much less complicated than, a business. A business has a lot of moving parts and targets aren't so clearly identified. You're looking for synergies and different things. So what you're saying makes a ton of sense. Like you run your business and let the experts come in and prep that business and make sure that the sale goes through. Is that kind of what you're saying?
Yeah. I mean, there's a couple of additional comments I'd make based off of what you just said. I think the first thing is it may be that you spend less money on advisory fees by doing it yourself, but I've really never been a part of a divestiture process where the uptake in actual value from running a process and having an advisor doesn't more than cover what the advisory fees are. Like we've never not paid for ourselves in a divestiture process, whether it's through the negotiation of working capital targets. I mean, we don't have to get super technical on this call necessarily, but there are various ways where you can generate value in the process and even just competitive tension, buyers knowing that you've hired a firm to run a process, you're taking it seriously, there's other groups involved, and it's a professional process. That in and of itself just kind of tells buyers that they need to put their best foot forward and they need to be competitive. And often that's enough to just generate the value itself. And then the second thing is, just based off the real estate example, what I think a lot of people who haven't gone through the sale of a business probably don't understand is that our processes will take, 8, 10, 12 months. It's a very, very involved process. Due diligence is often, 4 or 5 months of heavy due diligence. And it can be really taxing on management and business owners. And especially since there aren't going to be that many individuals within your business that are aware of a transaction. And so really it oftentimes falls on one to three individuals of a business. It can be very taxing. And so I think that, if I were to ever sell a business, and I have done this, you would definitely want to bring an advisor on to just make sure the process is run professionally. They're negotiating on your behalf. They're kind of taking the emotion out of it for yourself because it can be a very emotional process as well.
Oh, I'm sure. Yeah. I mean, it's the biggest asset that any business owner owns is their business generally. For most individuals, that would probably be their home. But for a business owner, yeah, how could you not be emotional? So I'd like to go in a bit of a different direction, talk about your career a bit before we sort of circle back into some questions about your current role, the anatomy of a typical deal, which you've touched on a bit, and then maybe even some war stories. So first, how did you get into corporate finance? Like, what was it about this field that made it attractive to you as a possible career path?
That's a good question, and I'm gonna caveat it by saying I wish I had a better answer for you. But it was really an opportunistic thing for me. I went to university out Eastern Canada in Ontario, and my plan was to kind of stay out there and build a career, I was really focused on going towards a sales career, which I don't think I realized at the time. Investment banking M&A work is very much sales as well as technical.
Right.
But I had a great opportunity. I met with the managing partner of Pricewaterhouse Corporate Finance when I was just finishing up my university career, and they were looking to add somebody in Vancouver in the corporate finance office. Typically at that time, accounting firms were only hiring CAs, or what are now called CPAs, out of their assurance practices to go into their corporate finance groups. And that's changed a little bit now. The landscape has changed a little bit. More firms are hiring directly out of university, but I had a great opportunity to meet an individual out there. We got along really well, and they took a bit of a flyer on me, and it ended up working out really well for my career.
Nice. Well, and congratulations. But what is it about sort of your work, your academic or your life experiences do you think helped you set up for success early on? Or conversely, was there anything maybe missing that you wish you had going in?
Yeah, that's a good question. So I think, there's both. I think like I said earlier, the work that we do is, heavily technical, and it's also heavily, I'll call it sales forward. So individuals that have been really successful building a career in M&A advisory, corporate finance, don't really have a weakness in that aspect. And so for me, I'd always kind of play team sports growing up. I was very confident on the sales side of things, and that really helps my career because I was able to do things like, be client facing very early in my career, where a lot of people struggle, or go out there and generate opportunities to bring in business where junior staff are typically not expected to do. But on the other end, coming straight out of university, yeah, we'd learned some technical skills in university, but, I wasn't a CA or a CPA. I didn't have that accounting background. And so that was it was a bit of a shortcoming at the beginning of my career, and I had to work really hard to develop those skills kind of on my own, because once you're in the fire, you don't have time to learn when you're on a live deal. You have to really go outside of that and develop your skills, whether it's through additional courses or designations or anything like that.
Interesting. You touched on something that I hear a lot, which is sports, and people citing sports, team sports in particular, as a way that they developed a lot of discipline, or that it helped them achieve greater success in their career. Would you be willing to unpack that a little bit? What specifically about sports was it that helped you?
Yeah, I don't know if I quite realized it at the time. Obviously my career in sports was when I was mostly in my kind of teens and early 20s. And so you're developing skills that you don't quite realize. One of them is, the most obvious one is just working with a team. The work that we do right now is heavily team-based. You're typically with a team of 3 or 4 or 5 individuals. And so you really need to be able to, have a common goal. You need to be able to divide tasks and really rely on your team members to do their job when they say they're going to. Because, if somebody doesn't do their job, then it really puts everybody else in a tough position, and it puts the deal in a tough position. And so what's great about sports is that you learn that when you're relied upon to do something, that you have to do it. And if you don't do it, your team members are going to suffer. So that was probably the number one thing that helped me early in my career, that some people don't. It's not that they don't have it, but they struggle with it earlier in their career if they don't have that background. And then the other kind of main thing is, you're not always going to be 100% when you come into the office. And so,
right.
That's a skill that you kind of develop in sports, is you're not always going to feel 100%. Sometimes you're sick, sometimes you're injured, Sometimes you didn't get a great sleep. Sometimes you had to be up late working, or you got home late on a road trip. And so really in the professional world, our clients don't really care how we're
Don't
feeling,
care.
or they just want you to do your job. And luckily I was able to build that skill without really knowing it, because you're forced to do it in sports, and that really helped.
Interesting. Great perspective. Thank you. If you weren't doing transaction advisory work, what would you be doing?
Well, that's a really good question. I dabbled a little bit in the middle of my career in business ownership. I say that, I caveat that a little bit because I think a lot of people, myself included, when I dove into that world, didn't really appreciate how difficult it was and how all-encompassing it is. And it's actually helped me become a much better advisor, just, having that empathy and understanding what our clients are going through and how hard they had to work to build to where they are today. And so, I'd love to get back into that world, whether it's, it could really be in anything. It's just, that intensity, that pressure of having to put food on the table for yourself and food on the table for your employees, and making sure that your customers are happy, your clients are happy. We're really kind of running our own businesses, even within the advisory group. Every deal is kind of its own income statement. It's its own customer base. And so we get a little bit of that, but I think if I wasn't doing that on the transaction side, I'd love to get back and do that on the operations side somewhere.
Explore that entrepreneurial spirit. I love it. So in terms of responsibilities, you're a director now, obviously, though you've worked your way up at an advisory firm like an MNP or PwC. How does it break down at the director level versus sort of say analyst or associate level? I'm talking specifically the proportion of time spent in financial models versus doing the kind of business development work and client management type stuff that you've talked about. What does it look like from a progression standpoint?
Yeah, I'll call it our junior staff, analyst, associate, really even the senior associate level. Your primary role is to be in the document preparation, kind of financial modeling, document preparation, research type work is going to be where you spend the majority of your time. Now, the one thing I'll say about that is that the business development skill set is not a switch that you can just turn on after 3 or 4 years. And so
Interesting.
For anybody that's entering this industry and really focused on doing a great job on the technical side of things, where you have to, it's table stakes. If you're not performing on the technical side, you're just not going to last very long. I would say that you really do need to sharpen up the emotional side of it to business development, even if it's just building out your network, and even if it's just other professionals. It doesn't have to be potential client facing, even though 90% of your work is going to be in documents, pitches, SIMs, financial models, just general research. It's always a skill set that you should be focused on developing throughout your career. But that's kind of on the junior end. As you kind of develop into we call them a senior associate plus. And so really senior associate manager, which is kind of falls VP and director and even managing director. You still need to have that initial skill set, because you're kind of the last line of defense between the buyers and the client and that sort of thing.
Right.
Your primary role is going to be outward facing. And so that's, whether it's client facing, marketing the business to potential buyers, and going out there and developing, prospecting and developing business. That's where kind of the back end role is. That being said, the due diligence process is typically very heavy. The marketing process to potential buyers is really heavy in our line of work. And so you do really have to be in the details, and you have to be there to manage the process. And you get that experience throughout. It's not something that you're expected to know how to do on day one. Once you're in this business long enough, you start to understand trends, and you start to understand why buyers are asking specific questions, and you can kind of develop that holistic strategy of the deal and become really good at that.
Be a little more proactive about, answering those questions and stuff too.
Exactly. Well, we always joke that we do most of our work up front so that we can kind of hash out any of the potential issues that could come out later in the process. And that's why it's really important to hire an advisor as well, because this is what we do every day. We know what can be a big issue, what can be a deal killer. We try and get ahead of those things to try and mitigate any damage on the back end.
Interesting. So you had a knack for, business development. You were saying sort of technical skills or table stakes. If you could go back to, the 6 months before starting in this role, what advice would you give yourself or to our listeners? Like, what are sort of the 1, 2, or 3 like absolute must-have skills or characteristics that you would have maybe practiced more to be better prepared?
Yeah, great question. The number one thing is accounting.
Okay.
And that's, a lot of people will look at finance jobs and see the financial modeling and that sort of thing, which is also really important. I mean, financial modeling and just the management of the balance sheet, the income statement, that type of thing, to project and to go backward looking and to kind of hash out any potential issues within a company's financials, really kind of reading the financial statements, understanding them, know how they interact with each other, know how they interact with what the operations of the business are. That's really a key technical component in what we do. And so if I could go back to 6 months before I started, I probably would have taken some accounting courses, some financial statement analysis courses, and just kind of developing that into financial modeling as well. I think, we call them the 3-way financial models: income statement, balance sheet, statement of cash flows. Understanding how those models work and how each statement kind of feeds into another is an absolute must technical skill. If you don't have it when you start, you better develop it very quickly, because it's going to be difficult unless you're feeling confident in those skills. And then on the other end, there's, I would say business writing is really important. It's something that most individuals people aren't really that skilled in, because it's not something that you practice very often when you're younger. And,
That's true.
Growing up, you read novels, you read all these different things, but you're not. Maybe it's a little bit different now with the younger generation being more interested in business at a younger age, but you're not really reading a lot of business books in your teens and early university years. So, we do a lot of writing in our line of work, whether it's pitches, confidential information memorandums, which is kind of the main marketing package, the SIMs that go out to prospective buyers. One of the biggest weaknesses on the technical side that we see with people just starting up in their careers is knowing how to be very concise in their writing and kind of synthesize information and keep it to a reasonable length within the SIM.
That's really good advice. Thanks for that. Let's go back to the role of an advisor in corporate finance. So there are different types of mandates. You've mentioned a few, like a divestiture, there's that, and there's also an acquisition. Those are sort of the two easiest to explain. I understand that you do more divestitures than like buy-side advisory deals or acquisitions. Is that accurate? And if so, why is that?
Yeah, I would say most advisory firms probably do a large majority of their work on the divestiture side, at least within, the BC lower mid-market corporate finance groups. There's one kind of main reason for that. It's just a more targeted mandate. If you're working on the divestiture side, your client has an asset, they know exactly what they're doing with it. They're looking to sell. And so It's a little bit more straightforward of a process. Now it can go in all sorts of different directions, but it's typically a more clear scope. On the acquisition side, it can be a clear scope, but oftentimes it's a little bit more blurry, and there has to be a very strong kind of vision on the acquisition side. And so they're less frequent. Typically companies that are looking at acquisitions as a main focus for their growth plan, they're typically larger companies and they have in-house corporate development teams. And so they tend to use advisors a little bit less, though we tend to be a little bit more selective with the groups that we want to do that acquisition work for, because, frankly, our fee structure is based off of the success of transactions. And so when you're doing a divestiture, the success of a transaction is a lot more in your hands, where on the acquisition side, it's just really difficult to get an acquisition done because you're typically very competitive and you don't typically have a specific asset in mind. You're out there kind of targeting, trying to develop relationships with sellers. That can take a lot of time. And so we do that work, but we're a lot more selective who we do that work with.
I guess you'd be looking for an acquisition target forever. So it becomes hard to collect a fee. Okay. So what about divesting business units, joint ventures, management buyouts? Like, can you tell us about some of the less common or less heralded types of mandates that you get? Like, what's something interesting that you guys do?
Yeah, I mean, I've been a part of most, if not kind of all of those things throughout my career. I would say that most of those things typically fall within what is typically looks and smells like a divestiture mandate.
Okay, how so?
I mean, when you're carving out a business unit, you're really treating a business unit like it's its own income statement, it's its own business. You're marketing it to a select group of buyers that makes sense within that business unit. On the accounting side, you have to be a little bit more careful because you have to, make sure that you're doing a proper carve out. You have to make sure that the income statement fairly presents what is, just represented business unit, but really you're still selling equity in a company to a prospective buyer. Joint venture side, we've done some of that work. One of the more interesting things that I've gotten to do throughout my career is just working with First Nations group to look at a potential joint venture with a private company. And so that's, that's very interesting work, lots of different dynamics at play, lots of, kind of heavy financial modeling for large projects and kind of working with the group to kind of assess the landscape, assess the buyer universe, assess the groups that they're potentially going into partnerships with.
Right.
And that was a really interesting kind of a mandate that we did a couple of years ago and continue to do regularly. So that's kind of one example of a non-typical thing we do. Although across our MMP network, across the country, I would say there isn't really anything that's non-typical, whether our office is doing it or our Ontario office is doing it, it's fairly similar, and we do all sorts of mandates.
Okay. So you mentioned that it's sort of like an 8 to 12 month process, a divestiture that was, I believe. What are the stages? Like there must be distinct stages to a divestiture. Could you walk us through that?
Yeah, definitely. So without getting too much into the details, because I could talk for hours about this is, a lot of our prospective clients want to know in great detail what the process is like. And so if there's anything you want to dig into, just stop me and we can do that. But the first part of the process, once a client has signed us up, although we can even take it a step backward and, we need to, oftentimes we're pitching to our clients what our services are, how we see the industry, the valuation kind of ranges that we're seeing. At this point, we'd like to dig into the financials and understand their financials, because the way most businesses, if not all businesses, are valued in the open market is a multiple of their cash flow, their normalized cash flow. And so in order for us to give a good understanding of what a valuation range could be, we need to have a good understanding of their financials and their business and their cash flows. And so we'll go in and we'll pitch and we'll answer questions. Sometimes that process takes a day, often not. Sometimes it takes years to develop that relationship. But once we're engaged, the first kind of main portion of a divestiture process is the information collecting and the development of the marketing materials. And so that's everything from doing a deep dive due diligence on the business, meeting with management, really understanding the ins and outs of the business, because in order for us to go to market and sell it, we need to know the business almost as well as our clients know the business, and better than how the knowledge of the buyer base that is going to be in there asking you questions. You really need to understand everything there is to know about the business. And in parallel with that, we're out there researching buyers. We're putting together a buyer list and developing the financial model, and working with the lawyers to develop kind of the preliminary, the NDA, what we're going to go out to market with. And so that's kind of stage one of the process. And that takes, that'll take anywhere from kind of two to 3 months is pretty normal for that process. And then once we're kind of ready to go to market, we launch and we contact potential buyers. We get them to sign confidentiality agreements. They get to review the materials, the financial model, and they'll ask kind of a first round of questions where we'll have calls, we'll have meetings with buyers. They'll provide, some initial diligence questions. We'll answer them. We'll help kind of liaise the answering those questions through management. But really, at this point, we're still very much the middle person between the company and the potential buyers. And so we're really taking the brunt of that work on the front end marketing. And buyers typically don't meet with management or meet with owners until after they've submitted their kind of preliminary offers. And so the marketing process can be, again, anywhere from kind of 2 to 3 months, depending on the type of process and how many buyers and how deep the initial diligence is. And that process kind of culminates with us receiving what we call expressions of interest, EOIs, or preliminary kind of non-binding offers.
Okay.
Next kind of stage of the process is we'll help our clients go through the preliminary offers, ask any kind of clarifying questions. We typically don't negotiate at this point. we're really just kind of understanding the offers and helping our clients make a decision on who are the respectable buyers, who do we want to bring into the next stage of the process and divulge more information and get to know a little bit more about what they're planning on doing with the business. And so typically we'll pick kind of anywhere from 2 to 5 parties to move forward with, depending on the size of the business and how many buyers are interested. And there will be a second round of diligence that is typically kind of a month to a month and a half of diligence. And that's a lot more involved with management. So we'll host management meetings where the prospective buyers will meet our clients or a select group within our client base, and they'll go out and see the facility at which the business operates in. They'll do a little bit more detailed due diligence. And all of that is to kind of get them in a position to submit their kind of final offers or their LOIs, letters of intent. And once we do that and we kind of work with the buyers and negotiate the key terms, the key legal terms, the key business terms, we'll work with our clients' lawyers to do that. We'll sign kind of one exclusive letter of intent to go move ahead and do kind of confirmatory due diligence with one buyer. Once we sign the LOI, it's anywhere from 60 to 90 days post LOI is the confirmatory diligence period before the transaction closes.
That was a lot of detail. Thank you. Quick question. From that sort of confirmatory diligence, like you found sort of your select buyer, like what proportion of those fall through roughly? Is it usually like a 90%? Yeah. Is it like a 90% success rate at that stage, or is it like 50? Like what are we talking about?
Yeah. I mean, I would say it's fairly high post LOI. I mean, there's always going to be things that can delay deals, that can, derail deals completely. But, typically once you're post LOI, if we've done a really good job and if the business has been operating kind of as a going concern in the status quo without too much impact to their operations, I would say it's a fairly high success rate. It's probably like 85, 90 and above. But there are always things that come up in confirmatory due diligence, and that's what we're there for, is to manage that process and manage, just because there's an issue that comes up doesn't mean that it's going to be a deal killer every time. Right. Typically, both buyers and sellers have invested a lot of time and money at that point in the process. And so really it's to the benefit of both groups to get the deal done post LOI, because a lot of time has gone into it.
Got it. Okay. You sort of segued into one of my other questions. I obviously we don't want any client details, but could you tell us about a transaction that went totally sideways? I like to hear horror stories once in a while.
Yeah. I mean, I think, without obviously getting into the detail of clients,
no details,
confidential, but I think one of the most interesting things that's happened over the last, 10 years, I mean, throughout my career for sure, and is very front of mind for people is the COVID period, because, there were a lot of people hadn't been through anything like that, or most people haven't really been through anything like that. And so
for sure,
we had multiple deals in market at the time, but one client specifically, their entire business was predicated on international travel. And so obviously when mid-March, when kind of everything started going sideways, their revenue went from whatever it was at the time to basically zero. And so at that time, we had received initial offers. We were just about to receive kind of LOIs, get to the back end of the process. And it was a very well-run process. There was a lot of competitive tension. And then, we were getting, management had a great management team. They were providing us with daily kind of revenue updates. And so the revenue updates started coming in, and they were very low or zero. And so what we decided to do kind of proactively was, instead of going forward and trying to manage that process and manage that turbulence with buyers, we kind of proactively put pens down and just put a pause on the process. We reached out to buyers and said, listen, the company is going to focus on their employees, focus on their operation, make sure they're taking care of everything internally. And we helped our clients do that throughout that process. And, we kind of kept communications open with buyers and really stayed ahead of the issues as opposed to trying to chase them all the time. And I thought we did a really, really good job of managing that in the company, and the management did a very good job of managing the business throughout that process. And we were able to come back online in 2021, continue the process while kind of still maintaining that competitive tension, and ended up getting a great result for our clients, and they had a successful exit. So definitely an uncertain time, a little bit of a few kind of dicey moments throughout that year
I'm
and
sure.
a half process, but ultimately ended up working out for the best.
A lesson that I take away from that is remembering that there's a lot of humans involved in this when crazy things like that happen. And to your point, like the transaction is not the biggest deal anymore. There's employees there that need to feed their families, and it's just, like there's just bigger things. And to pause the mandate kind of makes a lot of sense. Now that actually, I was going to ask you about interest rates, and again, an interesting segue because obviously rates went to nothing, zero, basically coming out of COVID, in COVID, and coming out of COVID. That put upward pressure on valuations, and now all of a sudden, several years later, rates have kind of skyrocketed. And my understanding is that that's kind of have the reverse effect, particularly in certain sectors like technology and what have you. So I'm curious to hear your thoughts on how this rising rate environment has impacted the M&A space in the private middle market, if at all. Like, is it changing the nature of discussions you're having with clients and prospects?
Yeah, that's a really good question. I think, everybody looks at kind of what they see on headlines and how, some of the bigger companies in the world are affected by interest rate changes. I think on the tech side, it's a very specific kind of phenomenon on the tech side because their growth is very much in the future. And so when you're doing valuation analysis on companies that are high growth and have growth that are, 10, 20 years down the road, they're going to be very sensitive to interest rates because it affects the discount rate. It affects, really what they're, without getting too technical, it affects what their valuation is today because they're not generating as much cash flow today as the typical clients that we deal with. Our clients, lower middle market private businesses, are very much, more stable, more cash flow generating businesses. And so the investment thesis for buyers should still work at 4% kind of bank rate as it did when it was a 1% rate, because they're not looking to, put 70% debt on this business and really lever it for cash flows that aren't going to be generated for the next kind of 5 to 10 years. They're
Right.
looking at being, not overly conservative, but fairly conservative with their leverage ratios and have a strategic kind of plan for these businesses. And so we're seeing less of an impact on the total valuation side, but we're definitely seeing some changes in structure from buyers. There's more introduction of deal characteristics such as vendor take back notes, where the seller kind of finances a portion of the transaction by lending to a buyer. We're seeing a little bit more on the earnout side, where a portion of the purchase price is contingent on the seller or the business kind of reaching certain milestones, whether it's revenue or EBITDA milestones. And so, obviously our job is to negotiate on the sell side the best possible deal for our clients, the most cash at close for our clients, and the less kind of risk on the back end of them not receiving their money. But, in an environment like this, in order to reach the valuations that you want to, there has to be some negotiation between sellers and buyers, and there has to be some give and take. And we're starting to see buyers implement more of those things to share some of that risk.
That's interesting. That's really interesting. I kind of want to ask you a few, I guess you call them technical questions. Folks in corporate finance obviously have to have a firm grasp of capital structure and a good understanding of debt. So can you explain in your words the difference between sub-debt and mezzanine debt?
Mezzanine debt and subordinate debt are similar in the sense that they're lower in priority to the assets than senior debt would be. And so, typically higher interest rates, different terms on the debt, but really subordinate debt and mezzanine debt is just a kind of form of subordinate debt. And that's a lot of times where, that's where the vendor take back notes will fall, is they'll be lower in security to the assets than a senior lender would be, but still senior to kind of the equity holders of the business. And so, not really much difference there. Higher interest rate, lower security, lower seniority. But
maybe some convertible features sometimes.
Yeah, they can have convertible features, but really they come down to being a higher risk and potentially higher return form of capital.
Right.
And more expensive to the people that are trying to raise that subject.
Okay, understood. My understanding of a sale transaction is that there are share sales and asset sales. So can you kind of unpack some of the different considerations there? Like what's unique and I guess maybe what's similar? And why might a vendor look to do one over the other? Or why might you advise a vendor to do one over the other?
Yeah, that's a really good question. I'll caveat it by saying that our group aren't like we're not tax experts, we will always kind of advise our clients to have tax experts. I mean, MNP has them, accounting firm will have them, but the main reason why a seller would want to do a share transaction versus an asset transaction is because everybody has what's called a lifetime capital gains exemption. And
that's a Canadian thing though, right?
That's a Canadian thing. Yeah.
Okay.
And so essentially what that means is when you're the ownership of a private Canadian corporation, you'll be able to divest the increase in value from the shares of your shareholdings up to a certain amount tax-free. And so, without getting too much into the details of it, if you sell the shares of your business, typically where the cost base of your shares were compared to what the value of the business is that you're selling, you're going to get an uptick in that value, and you have a portion of that uptick tax-free, and that could be, very, very, that's a material.
That could be meaningful.
Tax. Yeah, exactly.
Yeah.
And so that's the major reason why sellers will prefer a share transaction. Now, sometimes, there are other factors that come into play for buyers. There's a couple of reasons why, they may prefer an asset transaction. Although we're seeing a lot of, when I first started out in my career, there was a very large there was a bridge between buyers and sellers, and the buyers were almost always wanted to do an asset transaction and sellers were almost always wanted to do a share transaction. Now we're seeing a lot more flexibility within buyer groups as to, being okay doing kind of either. Obviously, maybe not so obviously, but for a buyer, you get a bump up in the cost base of the assets, and you can be a little bit more aggressive on amortization, getting to kind of the accounting side of things, and have some tax benefits from doing an asset transaction. But also, one of the other major things when you buy the shares of a business, you're buying kind of all of the past liabilities and past kind of issues that can come up, because those will vend with the shares. Right. So that, I think, used to be more of a problem than it is now. The legal purchase agreement will always have kind of indemnities. Sellers will always indemnify buyers against any kind of liabilities that would arise from the period from when the vendors own the shares versus to when the buyers have owned the shares. And so that's getting a little bit easier to manage throughout the share purchase negotiation and indemnities and reps and warranties.
So what I'm hearing is, both parties just want to optimize and maximize value and minimize risk. And so occasionally they butt heads, but less so now, it sounds like.
Yeah, I would say that, like, transaction structure wise, buyers have become a lot more open to working with what makes the most sense for vendors and working together to kind of find it comes out the most tax efficient process and tax efficient structure. And sometimes that requires them a little bit of adjustments to certain deal details or business terms of the deal, but we're to make that work.
Okay. So let's say you're looking to hire a new analyst or associate to join your team, and you've got like a stack of hundreds of resumes on your desk. I don't know if people still do paper resumes or not, but like, where do you even start? And I guess that's maybe a different way of asking, how should people, like our listeners and our members, think about standing out in such a competitive landscape for roles that are so highly sought after?
Yeah, that's a great question. The first piece of advice I would give, and it's really competitive now. Like, it was competitive when I was young. It's a lot more competitive now. I think there's a lot more information out there, and more young people know what they want to get into early on in their lives compared to when I was kind of high school or university. And so I can appreciate that it's a very competitive world out there. The one piece of advice that I'd give is it's not really enough to just send your resume in, because, like you said, there are so many resumes out there that, even if you have a really strong resume, there's going to be a lot of other people that have strong resumes. And so you really need to supplement just applying for a job and sending in your resume with, getting your feet on the ground, meeting people, having coffees with people that are doing the hiring, understanding how firms are looking at hiring, the timing, the internship opportunities they might have, and just kind of getting yourself ingrained within the network. It's also great practice for, how you build your professional network once you start working too. But, for me, if I see a resume and I've met with that person or I've talked to that person and I see their name on the top, I'm going to have more time to read that as opposed to just reading a random resume of somebody that I've never met before. So that's kind of the first piece of advice, is to supplement. But the second piece, and I think a lot of people might not do this as much, is kind of tailoring your application to the role that you're applying to. And that comes
Okay.
right down to tailoring your resume. But there's a lot of upfront work that goes into that, because you need to really understand what the role is, what's involved, the skill sets that you need to have, and tailoring your resume to show that you have those skill sets. And so, I think when I was applying for roles, when I was in university, sending my resume out, I would kind of just send the same resume out to everyone because I didn't really know any better. And so, if I could go back and do it again, I would have, M&A, corporate finance is something that I really wanted to get into. I would have sat down with someone, really understood the role, understood what you needed to be good at, what the skill sets were, what the technical aspects were. And I would have tailored my experiences to show how I can demonstrate those skill sets. Obviously, you're restricted on your resume to what your actual experiences are.
Can't make stuff up.
You can't make stuff up, but, I had some great sports background, and I would have tailored, some of that information to how beneficial it would have been to working on a deal team and developing business. And even just, even the technical aspect, you're going to have course in school or aspects of previous jobs that you've had that can really be tailored to what we do on a day-to-day basis. And that's something that I think can be lacking sometimes if you are just trying to get your name out there and trying to kind of use the shotgun approach of, the more I apply, the better chance I'm going to have to get hired.
Interesting. Yeah, that's really good. That's really good feedback. And we appreciate this advice from someone that's in the mix. So another question, a lot of members of the CFI community are in financial services already, and many of whom have, business development mandates like you've talked about. So without giving us your secret sauce, are there any strategies that you find really helpful in terms of like drumming up new business for your firm?
Yeah, I mean, I don't even know if it's that much of a secret sauce. So I'm fine kind of giving advice on that front, because there's no real easy way to generate that business. It could be, you just need to be out and meeting people. I mean, I joke with our senior staff, and I think that they give me a hard time sometimes because I just consider every time I talk to someone or every person I meet or every situation that I'm in as a business development opportunity, because really like our client base is going to be business owners or executives of businesses, and you just have no idea who is in what position until you get to know them, until you meet them,
or who their neighbor is,
or even somebody that they just know, somebody that they know that has a business and wants to exit and doesn't know what to do. I think a lot of business owners don't even know that selling your business is a plan that you can have. I think people will just start a business, work in that business their entire lives, and it'll be their jobs and their lives and a way to kind of put food on the table for their families, and they don't think about any succession planning. And that's why a lot of times the transition between generations fails, because there is no succession planning. And so, my advice for business development would be to get out and meet people and get involved in your community, whether it's, you can do board work, you can do volunteering, you can do coaching sports. Like I did sport coaching very early in my career, and that was really beneficial for me to build my network out. And it's generated, great opportunities from my career. So there's no secret sauce, and there's no kind of limit to how much you can be out in your community and getting people to know you and working with people to get them to trust you.
That's really sound advice. Are there any, books, podcasts, speakers, other resources, like thought leaders that you're into these days that might resonate with our audience?
Yeah, I mean, book wise, I do a lot of reading that's not necessarily kind of business reading. I'll do a lot of fiction or just kind of journalistic reading. Like probably the best book I've read in the last few years is that Bill Browder book, Red Notice. Kind of has a business. It's nonfiction, but it has a kind of business and a novel factor to it. And just, I try to get my mind off of work because it's on work. Yeah. It's on work a lot. So, but that being said, like, some of the kind of historical deal making books, like I think it was Black Edge was one book that I read somewhere. It's not a new book, but
I love Barbarians at the Gate. Have you read?
Yeah, it's another great deal book. But I think, those types of things I think are important, but I would say what's more beneficial to for individuals looking to get into the space or looking to be successful is just kind of daily, even just reading the news, having an idea of what's going on globally, and having conversation topics, I think, is a really important thing to have, because you're going to be meeting, I mean, especially if you're going to be doing business development, just having an idea of what's going on in the world, showing an interest in what's going on around you. Oftentimes, you're really just trying to build trust. And, it seems like a very basic piece of advice to give, but being able to hold a conversation on current events is, sometimes all you need to, provide interest in someone, show somebody that you're interested in the world. And that might be all that you need. It might not even be any more technical than that. And then on the podcast side, I honestly really love listening to, people that have worked in finance for like 20 or 30 years. Whether it's like a Tim Ferriss podcast, or I've got a
very talented too.
Yeah. Like really, really great guests, and they just tell stories about, and I tend to kind of gravitate towards like movie producers and ex-finance or current finance professionals. And I don't know what it is, because they just have great stories, and they always have, great insights into how they've dealt with certain situations, or how they dealt with individuals and managed a process and deals that they've done. And so that's kind of where I aim my focus. And that's pretty much
That's a lot of good resources. And it sounds so logical, like watch the news, read know what's going on in the world, but we don't always do it. Not everyone always does it. So it's good advice. Listen, I'm cognizant of time, and you've kindly given us quite a lot of yours. So again, thank you. But if I may, just one final question. What keeps you up at night?
I'm up all night thinking about all the deals that we're working on. Yeah, I mean, it's so all encompassing. Like I think the one thing that you have to understand getting into this world is that like the deals that we work on are very dynamic, and things can change at all times. So we're always like, if you're a good advisor, good M&A professional, like you're always trying to look 6, 7, 8, 9, 10 steps ahead. And so when you're in a process, you're always kind of thinking that way. And one of, if not the favorite part of my job, is building a strong relationship with our clients and the business owners and the CEOs and the CFOs. And if we're doing our job really well, you become a trusted advisor, and you're helping them throughout the process. They're calling you at night, talking about what they're worried about or asking you questions about their business. And you're really kind of becoming a part of their team. And that's, having that mindset of, this isn't the type of job where you leave work at work. You bring it home. You're always thinking about the deal. You're always thinking about how you can help your clients. And so it's not so much that it keeps me up at night, but it's always something that is on your mind, and you have to learn how to kind of balance your life and balance the other important things that you've going on in your life, whether it's family or kids or sports or kind of friends or anything like that, to manage your mindset so that you don't overload yourself.
It sounds equally invigorating and stressful. So kudos to you and the work that you do on behalf of your clients. Where can people go to learn more about you and M&P if they're interested? Are you active on LinkedIn or other social media?
Yeah, I'm on LinkedIn. LinkedIn is just my name. I'm sure we can put it in show notes or whatever.
Yeah, put it in the show notes. Don't worry.
And M&P. I mean, you can look on our website, but we've got some great resources on our website that just talk about some of the deals that we've done across the country. And maybe I can give you that link as well to put in the show notes. And just we call them tombstones, but really they're just kind of deal summaries and buyer and seller summaries on deals that we've done. And so we've done work with some incredible sellers and buyers across the world. And so I'm always happy to share more stories on some of those deals to the extent I can, and meet with people and have those conversations.
Terrific. For our listeners that are interested in corporate finance and learning more about some of the roles that exist out there, CFI also has a ton of resources on this, including our updated career map. And we'll be sure to provide that in the show notes as well. And I encourage you to dig around a bit. Yash, this has been incredibly insightful. Thank you so much for sharing your time and your insights with us.
Yeah, thanks. I had fun.
Thanks for listening to this episode of Net Learnings. This podcast is powered by CFI, an organization on a mission to enhance the skills, knowledge, and productivity of finance and banking professionals. If you enjoyed what you heard in this episode, make sure to follow Net Learnings wherever you listen to your favorite podcasts, or visit us online at corporatefinanceinstitute.com/podcast. See you next time.